Hello everyone, my name is Anjani Kumar Khetan, and in this particular video we will conclude our discussion on sell and leaseback transactions which we started last week, and we will look at how the accounting has to happen for such transactions if the initial transaction of sale of the asset was not at the fair value. Let's quickly recap what we discussed, the key principles in the last video. And we have seen that if the transfer of the asset initially, when the seller is selling those assets to the counterparty, which is basically the buyer-lessor. So in that case, if that underlying transfer is not a sale, that means if the transfer does not meet the criteria for sale as contemplated under Ind AS 115, then we have seen that it's a financing transaction which is covered under Financial Instrument Standard Ind AS 109 or IFRS 9. However, if we look at the right hand side, if we say that no, the transfer of the asset by the seller-lessee, if it meets the test of a sale as contemplated under Ind AS 115, which we saw here, then in that case, the accounting has to be governed by Ind AS 116. And we saw in the last video that the underlying sale was at a fair value. Now, what happens if the initial sale itself is not at fair value? So this is what we saw in the last video. So I have given you here a quick access of the QR code in case you have not seen the last week's video. If you scan this QR code, you will get to the last week's video wherein we discussed, right, if the sale is at fair value. Now we will look at the next scenario if the sale is not at fair value. We will use the similar example which we saw, just that the number is something which we will change. Now in this case, we have the same scenario wherein CityCorp, the seller, is selling this particular building to the buyer, Mr. X. The carrying amount of the building on the date of sale is 10 lakh rupees, but it is sold at a price of 20 lakh rupees. So Mr. X gives the sale consideration of 20 lakhs, and on the date of sale, the fair value of this building was only 18 lakh rupees. So 2-3 things what we need to be aware of here. The book value of the carrying amount is 10 lakhs. The fair value on the date of sale is 18 lakhs, but it is sold at a price which is not at a fair value at 20 lakhs. So compared to the fair value of 18 lakhs, the sale consideration given by Mr. X to the CityCorp is excess to the extent of 2 lakh rupees. Now, here also we are presuming that the transfer of the building constitutes a valid sale as contemplated under Ind AS 115 or IFRS 15. And as a result of this sale transaction, in the second leg, Mr. X basically leases back the same building back to CityCorp for a period of 18 years, and the yearly lease rental is 1,20,000 rupees per annum, payable at the end of the year. And in this case, it is given in the case study that interest rate implicit in the lease is 4.5% per annum. Now the question is how this transaction will be recorded by both the parties. Now this is a difference because in the last case study, we have looked at only the accounting by the CityCorp. Now in this case study, we will extend this example and also look at not only the accounting by CityCorp, but also by this buyer-seller, Mr. X also. Okay, so with that background, let us quickly look at some of the key calculations for CityCorp in this case. Now, considering that the sale consideration is 20 lakhs, which is not at fair value of 18 lakh rupees, sale consideration is not at fair value of the building is 18 lakhs, but it is sold as 20 lakh. So it will be reckoned in this case that to the extent of the excess amount of 2 lakh rupees, it will be reckoned that Mr. X has given a loan to City Corp, and therefore the additional amount of 2 lakh is considered as an additional funding or the loan which has been given by Mr. X to City Corp. Right? This is the first thing which we need to be aware of. Now, moving further, therefore, if you look at the total lease rental, which the present value of the total lease rental here in the sale back, 1,20,000 is the annual lease rental. And this lease back is for 18-year period. So, as we saw in the earlier video also, the present value of the annual lease payment over this 18-year period is 14,59,200, representing 1,20,000, which is the annual lease rental, and multiplied by present value interest factor annuity, because the amount is the same, at discount factor of 4.5%. Now, the difference between this case study and the previous case study is on account of this additional funding of 2 lakh rupees. So, in this case, though the total present value of the annual lease payments contractually is determined to be 14,59,200, you need to split this into 2 parts. Out of this 14,59,200, 2 lakh is basically represents the additional financing which has been given by X to City Corp. And therefore, your real lease rental in respect of the leaseback is the balance amount of 12,59,200, representing the gross amount of this minus the additional funding. So 14,59,200 minus 2 lakh, that will give you the real component of the annual lease payments for the leaseback which you have got for the this particular building. Continuing on the next slide, I brought forward the calculations on the chart which we put on the last slide. Now, when it comes to City Corp, in the books of City Corp, how City Corp will record? Here, compared to the previous case study, the calculations will change. As we saw in the last video, the calculations will change because there is an element of 2 lakhs of the funding as well. So therefore, here you need to start with the real present value of the lease rental in respect of the leaseback transaction. This amount is net of the 2 lakh rupees of funding. So excluding the financing component, the present value of the annual lease payments will be 12,59,200 as we computed in the last slide, representing the gross amount of 14,59,200 minus 2 lakh of the financing. Now, I'll come back on this ROU asset to be recorded. First, let us look at the bottom. Also, I have told you in this case, how much is the gain? The gain on the total building is basically the fair value minus this. You cannot compute gain of 20 lakh minus 10 lakh. No, because this includes 2 lakhs of the financing. Therefore, the gain on the building is total gain is only 8 lakh rupees, representing the fair value of the building on the date of sale, which is 18 lakh minus the carrying amount of 10 lakhs. Okay, so your total gain on the building will remain this. Now we need to figure out what is the right which have been retained by City Corp due to this leaseback transaction and how much have been transferred. Similar to what we saw in the earlier video, but the calculations will change. If you look at on the right hand side, what is the rights which have been transferred and how much has been retained is something which is being computed here. So, if the fair value of the asset transferred is 18 lakh rupees, out of which 12,59,200 is what you have effectively retained net of the financing component of 2 lakhs, then in that case, what you have actually transferred to Mr. X is 18 lakh minus 12,59,200, representing 540,800. So fair value minus the net right which have been reacquired on the leaseback after removing the effect of the financing impact of 2 lakh. And therefore, what they have transferred is 5,40,800, which is as a percentage of the 18 lakh turns out to be 30%, which means as a corollary, or if 30% is something which has been transferred, that means 70% has been retained by way of the leaseback transactions. Therefore, out of the total profit of 8 lakh rupees, only to the extent of the portion which you have transferred, that is only 30%. So 30% of 8 lakh, that is the only amount which you will be able to recognize in the P&L as the gain on transfer of the building. Right? So as we discussed in the last slide or in the last case study last week also, now you have to look at the 30% number. So 30% of this 8 lakh, 2 lakh 40,000. I mean, you can see there is some rounding off because here it is a decimal which is not captured in the slide. It is not exactly 30%, it's slightly more, and that's why it is not a round number 2,40,000. It's slightly more than that. So roughly, if you look at the net 30 point something would be your transfer, and that's why it is not exactly 30% of 8 lakh to 40. It is 2,40,356. Now, this 2,40,356, which is the profit which the seller-lessee will be able to recognize on sale of the building. So how the journal entries will look like? Look at the right hand side bottom. Similar to what we saw in the last slide, in the last case study last week, just that here the numbers will change, and you will also have to bring in the 2 lakh rupees of financing component in the entire scheme of journal entries. So how it will be? Let us see here. So what happens in this case? You are effectively getting cash of 20 lakhs. So debit cash 20 lakhs, the consideration which you have got. Now this consideration was 2 parts, 18 lakh and 2 lakh. But then you have to de-recognize this building. So building will be de-recognized at the carrying amount of 10 lakh rupees. What is your financing? The total liability. How much is your total liability? Basically, this 12,59,200 plus 2 lakh of financing. So I have put in here financial liability consisting of the 2 parts of 12,59,200 and 2 lakh, aggregating the gross amount of 14,59,200. Right? This is the total obligation which you have agreed, including that funding of or additional funding of 2 lakh rupees. Now, what is ROU set? ROU set, as I given you the example earlier also, the other way is that we have already computed the gain on sale of the building, which is this number 240,356. So you may either arrive at ROU as the balancing figure, or you may compute the ROU number as given in the formula itself. So let us first look at, if you calculate ROU as the balancing number, 20 lakhs cash received, 10 lakh building de-recognized, financial liability consisting of the 2 parts of 14,59,200, and gain as computed 240,356. So this 699,556 would be 20 lakh minus sum total of all of these 3 numbers. That is one way to compute. But how this 699,556 can be calculated directly, it is given here. Again, same way, it is basically this lease liability net of the financing as a proportion of carrying amount to the fair value. Carrying amount of 10 lakhs, fair value on the date of sale, 18 lakh. So 12,59,200 as a percentage of this ratio, 10 lakh divided by 18 lakh. That is the way this number is computed. But as I mentioned, you can use it as a balancing figure. Also, it will work out to be the same. That is the way the accounting will be done by City Corp. But what about this? The counterparty. how they will do the accounting. Let us see how Mr. X will do the accounting on the next slide. When it comes to Mr. X, yes, because it's a valid sale transaction, the building now belongs to Mr. X. So they will record building at fair value of 18 lakh rupees. They are paying cash. X is paying cash to the extent of 20 lakhs. Credit bank, 20 lakhs. And the balance 2 lakh is the loan which have been given, additional funding which have been given to CityCorp. And therefore, that 2 lakh will be debited as a financial asset, loan given to CityCorp. That is the first entry which X will record for the purpose of the acquisition of the building from CityCorp. What next? Now, accordingly, in this case, the leasing back of the building to CityCorp will depend upon the accounting for the leaseback, accounting for leaseback from the lessor to the lessee will depend upon the evaluation of whether the risk and reward of ownership has been transferred by CityCorp to, transferred by Mr. X to CityCorp. Now, under Ind AS 116 or IFRS 16, there are primary indicators and secondary indicators of evaluation of whether the risk and reward have been transferred from this party to the other party, and should it be a finance lease or an operating lease. Because under IFRS 16 and Ind AS 116, the single lease model applies only to the lessee. Lessor is still required to differentiate between the finance lease and operating lease. So therefore, as a lessor, Mr. X will need to evaluate whether the leaseback is in the nature of finance lease or operating lease, and then do the accounting accordingly. So if it is depending upon, as I said, if risk and reward of ownership is transferred, then in that case, finance lease accounting will be applicable, and if it is not, operating lease accounting will be applicable, thereby meaning that Mr. X will apply the lessor accounting. The X will apply the lessor accounting of either operating lease or finance lease, as the case may be, depending upon the risk and reward of ownership, whether it has been transferred to CityCorp or not. Now, this is fine. Assume that it is a finance lease for the time being. Now, what about subsequent measurement? Subsequently, if it's a finance lease, this guy is receiving a total 1,20,000 as the annual lease rental. Now, this 1,20,000 need to be split between what relates to the financing arrangement of 2 lakh rupees and what relates to the lease payment itself. Therefore, in the ratio of this 1259,200 and 2 lakh, which is the original calculation we did, the gross amount of 1459,200 is split into these two parts. So in this ratio, in the ratio of 1259,200 to this and 2 lakh divided by this, in this ratio, this amount need to be split. That will be the proportionate amount which is in respect of the lease payments or for financing arrangement. Therefore, if you look at the calculations, out of 1,20,000, a sum of 1,03,553, which is computed here, this relates to the lease payment. Whereas an amount equal to 16,447 out of this 1,20,000 computed as this 1,20,000 total amount in the ratio of 2 lakh divided by 1459,200. This is the component which is for basically financing arrangement. So partly it is like this is the amount which you are paying towards this financing arrangement. Right? This is the way in the subsequent measurement the lessor will split the entire amount of 1,20,000, and to the extent of this lease payment, they will apply the lessor accounting, which is in this case as I mentioned, assuming if it's a finance lease, they will apply finance lease accounting. And this amount is something to which Ind AS 109 financial instruments accounting would be applicable. That means here you will have to develop debt amortization table for this 2 lakh rupees in such a way that during the period of the lease, the amount gets knocked off to 0. How that is being done? I am giving you a detailed calculations and the conclusion on the next slide. Right? Let us see. First, let us look at the next slide, the full amount of 1,20,000 which is being paid. So if you look at the total amount, 1,20,000 is being paid every single year over the 18-year period. Now, if you consider that the total financial liability consisting of the 2 component on leaseback plus the financing component was 1459,200. So your opening liability consisting of both the component is 1415,200. You will compute interest of 4.5%, the rate which you have used for discounting on this opening balance, but you will continue to make the payment of 1,20,000 contractually agreed. Therefore, opening balance plus interest accrual minus what the payment you have done is your closing balance. That becomes opening. Same process you repeat for all the 18 years, and therefore by the end of the 18 years, what you have is the total amount, the liability gets knocked off. Now this table has the liability consisting of both the leaseback related lease payment as well as the financing. Now if you just want to see for your calculation purposes, if you want to see, if you were to separate this 1459 into 2 parts, the table, the lease amortization table for the financing component of 2 lakh rupees will look like this. It's exactly the same calculation, just that you are starting it for only the financing component of 2 lakh. You will continue to use the same 4.5%, and this is the amount which we computed in the last slide. A split of 1,20,000. That split, this 14,447, relates to the financing component as we saw in the last slide. That amount is the payment in respect of this financing arrangement, and same calculation you do by the end of the 18th year, this funding will become 0. And then the last bit of it is that your lease liability schedule, net amount, net lease liability schedule, if you total minus 2 lakh is 1,259, same principle you will apply, just that here the amount will be 1,03,553, which we computed in the last slide. So effectively 1,03,553 plus 16,447, these collectively becomes 1,20,000. Right? So this is what I wanted to cover for this particular video. This completes our discussion on accounting for sale and leaseback, which is basically 2 scenarios where the original sale was at fair value and not at fair value. Today we have seen if it is not at fair value. Now, we still have to look at some of the recent amendments which have come in the field of sale and leaseback accounting. So, there have been amendments both under Ind AS and under IFRS. There are recent amendments wherein some more clarifications have been given. Because, see, what happens in this case? In all the case studies which we have seen so far, let's say here, what did we see? What we said here is, let me just, here. The lease rental, what we said is 1,20,000 rupees. Is a flat fixed number. If you see here, we are saying, even in the previous case study, we said lease rental is 1,20,000. Now the amendment has come to clarify what happens if part of the lease rental or the lease payment is variable in nature. If it is not fixed, in both the case studies we saw, it is fixed. But what complications it may create if the lease payments are variable? That amendment explains the accounting for that. So in the next 2 videos, we will explain the recent amendment which has come in the field of the sale and leaseback accounting, and that will complete our discussion on the entire topic of sale and leaseback. So this is what I wanted to cover for this particular video. As usual, I've given you a gist of some of the series of videos which are available on my channel. Please do connect with me. This is the link of my YouTube channel. Please do subscribe, share, comment, whichever way you are able to help the channel. It will be very helpful. You can feel free if you want to forward this the link of the channel to anyone who is interested in this kind of content. I will really appreciate your help in that. Okay, that's exactly I wanted to cover. This is again the link of my LinkedIn page. Feel free to connect with me. Thank you. I'll take a pause. Thank you and bye for now.